If you're newer to the insurance business, you're selling life insurance, thinking about selling life insurance, whether that's mortgage protection, index universal life, whole life, final expense, that all is life insurance. And it's important to understand how you are going to get paid and what you can expect when it comes to commissions. And even more importantly, to understand where the pitfalls are and how commission works. There's a big multi-level marketing influence in this business, and sometimes they're out to take more money than they deserve. And so what you have to do is empower yourself with knowledge and understanding of what the options are and what the reality is when it comes to getting paid on your life insurance-based deals. And so what we're going to be talking about today is really just more or less a blueprint, a guide on everything you need to know about how commission works so that you don't make unnecessary mistakes with partnering with agencies and to make sure you get what you are worth and what you should be paid. Of course, my name is Dave Duford. I own Duford Insurance Group. If you're interested in selling final expense face-to-face or over the phone, and you believe mentorship is a valuable component to your success, that is our specialty in the one-on-one mentorship arena. We mentor all of our agents that join our agency. If you'd like to learn more, davidduford.com/FAQ. And if you like to watch these videos live, we're actually filming the videos right now in our insurance sales success community. We have 30 plus hours of deep dive tutorials on final expense, Medicare, annuities, and health insurance. We have scripts, live training, of course, like this to watch. You're welcome to join completely for free. There's no charge whatsoever. If you'd like to join, go to davidduford.com/ISS. Okay, so let's get started. Okay, so commission, how is commission determined for life insurance? It's very simple. This is how it should be. Now, sometimes there are games that are played, I would call window dressing, and we'll get into that in a little bit. But here's how commission should be determined when it comes to what you can expect to pocket into your billfold when it comes to your sales. So commission is determined by what's called annual premium. The annual premium can be thought of as a monthly premium multiplied by 12 months, right? 12 months equals a year. Annual premium. Makes sense? It's not exactly 12 months times the monthly premium. It's about 11 months, give or take. But that's a rough estimate of what to expect. So we take that annual premium, and then you take that and multiply it by the commission rate associated with the life insurance product. And of course, this is where all the fun happens, right? Commissions can be high. Commissions can be low. Commissions can be fairly priced. They can be completely unfairly priced. And hopefully, as we go through the discourse of today's conversation, you'll understand how to determine if my commission, based on my offer and what my organization is offering me, is actually fair or not, and what you can do about it. So one thing I will address, because this is often, especially with like the mega MLMs that pay really low, a lot of people are surprised, like, how can I get paid more than 100%? And it's like, how can I get paid all of the commission? Don't you need to get paid, Dave? Well, there's a misunderstanding, I think, with how commission is determined. It's 100% of what, right? It's 100% of the annual premium. The reality is the big IMOs, the big agencies, the companies dole out contracts in the 150 to 170% range of the annual premium. So even if you're paid at 100%, that's not all of the commission. That is just a function of the annual premium, whereas the top end, like the big mega organizations, the big distributors, depending on the carriers, it does vary. It can be as low as 125, 130%, as high as 170%. So understand this, a lot of MLMs will say, there's no way you can make more than 100%. They know that you can. They're saying this because they don't want you to think for yourself and find out, guess what? You're getting ripped off and you're not getting paid what you're worth. So understand you're not getting all the commission, but the commission, when somebody says 100%, 110, 120%, that is multiplied by the annual premium. And there's certainly more above that the organizations, the IMOs, et cetera, get paid. Okay. So I want to make sure that is clear. So a couple other factors you got to be concerned about when you're getting paid is the timing of which you get paid and also what's called advancing. These are other factors of life insurance, no matter what kind that you're selling, that you need to be aware of. So there are two ways to get paid on a speed basis, what's called pay on issue, and then also what's called pay on first payment or pay on first draft. What's the difference? Pay on issue refers to when the policy is approved and then the policy is set up as issued, like it's done issuing, old-fashioned way of printing off, and then it's put in the mail. It is now issued. And you get paid when that happens, keyword, even if the payment hasn't been processed. So we'll come back to that in a minute. Pay on first draft would be, hey, whenever the first payment comes in, so Johnny sets up a call on Mildred and gets her set up for June the 1st. He's not going to get paid until after June the 1st because it's May the 1st today. We got a whole month to pass, so there's no money made from that sale until June 1st comes, so successfully collected, and then you get paid at that point. So what's the difference? Well, if Johnny writes a deal today on Mildred and uses a carrier that pays on issue, then what happens is a couple of days from now, he'll get paid his advance commission. Whereas if he's paid on first draft, what happens is he's not paid until a month from now because June 1st is a long time from now. So which one is better? Well, both are fine. And what you'll find more often than not is most carriers pay on advance because one of the key things that are really important for agents is cash flow. Cash is king in this business. Have you heard of that before in business? Cash flow really is king. The speed at which you get paid is really important. Why? Because if you're selling life insurance, you likely have leads you're buying. You likely have to pay a vendor to get leads. And so the speed at which you get paid is helpful because if I can pay down my balance, I have that much more ability to buy more leads. Does that make sense? So whereas if I'm not paid till first draft a month from now, well, I made a sale, but what if it takes a month to get paid, right? So the cash flow is much slower and it's harder on your balance, your bankroll, to support a lead campaign if it's just on a first draft basis. So what's the downside to paying on an advance on issue? The downside is that there's a financing risk. It's called an advance commission. Just because Mildred took out a policy and bought it from you doesn't mean she'll cancel it or that first premium won't come through. So you're putting yourself up while you get paid faster on an advance up front on issue. There is a financing risk in the sense that, well, if she cancels her plan or misses payment, you now owe that money back in form of what's called a chargeback, okay? Whereas with a first draft setup, you avoid that a little bit. I mean, there's still an advance, but you avoid that initial upfront advancing finance risk that is inherent whenever you get paid on issues. That makes sense, everybody? Hopefully it does. So what's an advance? Because we got to cover an advance. Here's the thing. When you make a sale with insurance and it's on a monthly basis, you're usually with life insurance products going to get paid 75% of the entire commission that you're owed for the year, okay? The other 25% comes out months 10, 11, and 12 after the advance balance passes and is zeroed out. An advance, in other words, is a loan. You are being loaned an advance commission, and it's, again, paying in advance or in lieu of the policy you sold actually staying on the books for that period of time that the advance is good for. Again, the standard with most life insurance companies is 75% or 9 months worth of monthly commission paid up front. So what's the problem with advances? Well, like we said earlier, if Mildred cancels the policy, you now owe back the money that was advanced to you. And a lot of people don't realize this. I mean, it's not really talked about, to be frank with you, except by people like me who try to keep things square and transparent. If you pay with many of these plans, or Mildred pays in 3 months, and you're advanced 9 months, you now owe back 6 months worth of commission. You now have what's called a debit balance. And you either have to cut a check for it, they'll give you time to pay it, or like most agents do, you just write another piece of business that covers that balance, and then you get paid the difference of what's left. Advancing is a part of the business. And I would go so far as to say everybody here is probably going to be on an advance commission basis. Because maybe one of your reactions are, well, I don't want to take an advance if I risk owing money back to the company or the agency. Well, that's all well and good until you realize, well, how am I going to pay for my leads? Most of us don't have 100 grand sitting around in a bank account that we can just work off of that while we get paid a little bit of as earned and it grows over time. So long story short, advancing is a real thing. The chargebacks from those are a real thing, and that everybody's going to have it if you want to have cash flow in this business, because without cash flow, you don't have a business. It's a great way to get out of business sooner than later. So it is what it is. It's a part of the business. How do you mitigate and reduce advance chargeback issues? You sell the right way. You don't overpressure the client. You sell according to what they can easily afford. You encourage them to buy, but you don't pressure them to buy or bully them to buy. And you make sure, in my opinion, you carry multiple companies. This is why DeFord Insurance Group believes in the independent model, because we like to shop for our clients to get them the best combination of price and coverage, because the likelihood of another agent coming behind in 90 days is pretty high. And if we've sold an overpriced one product company, then what happens, there's a risk potentially that will get replaced. And now we've got what? A chargeback that we have to pay back. So having multiple carriers reduces across the board the risk of replacement, thus chargebacks, and then also having, good sales tactics to make sure our clients keep what is sold to them is the other part to reduce the risk of chargebacks. Now, a couple other things before we wrap up this segment that are really important to understand. Number one, how do the companies and IMOs and MLMs out there screw you on commission? Because here's the thing. You're coming into this business, you really know nothing about it except what the person who brought you in told you. There's usually a lot more information out there that you just won't know until you experience it, or if you're lucky enough to stumble across what it is that we do and learn from the experiences of somebody who likes to show the whole thing, not just a little bit of it. So you got to be wary of what goes on, because sometimes the things that are presented to you are something entirely different. What I would propose to you is that if things aren't transparent, and what you learn today maybe is in contrast to what you were told, and you find out what I've said is true, you need to start questioning the entirety of the relationship. Generally speaking, if you start a relationship with a lie, it doesn't get better. It usually gets worse. And especially when we're talking about business, it should be just like a marriage: transparent, honest, straightforward, no secrets. You want to be honest with your partner in business as well as love, right? So a couple of things here to get you aware, to make sure that you have and are empowered with the knowledge to make a decision. Number one, there are carriers that will do what I call window dressing, not carriers, excuse me, IMOs, MLMs specifically, where they take this idea of commission and then spin it on top of its head. So they do a percentage of a percentage. and the agency that does this, they've been around forever. If I mention them, you'd know who it is. I just can't imagine. They just love to think of new ways to screw agents. That's just how they live. It's how they roll. And you wouldn't know it because they're such nice people on the outside. But again, you start seeing what they actually do. It's pathetic. Okay, so what do? So they'll say things like, you're on 100% contract, but you're at the 70% level. Or they'll do something like, you're at a 90% contract, but your contracts pay you at a 40%. So what happens is that you get paid 90% of 40%. And the reason they did this is because in the past 5 years, the one thing I can say for sure is there's been a good momentum to get agents paid more of what they should be paid, and to unencumber themselves from the MLM push of lowering commissions substantially. So what these MLMs have done, some of them, is they show a high percentage commission, but then it's a percentage of a lower percentage. So you get paid even lower percentage. So if I'm at a 90% contract, or if I'm at a 90% level of a 50% contract, what's 90% of 50? 45. It's even worse than it sounds. But they don't explain this to you. They just sound excited. Hey, you're at a 90% contract. You're almost at the highest contract we can get you. But because, frankly, a lot of people just don't do the math and don't realize comparably what else is out there, they get really screwed. So you got to be very, very careful when it comes to how the structure is made. There's another IMO, very common one that's out there. You see them everywhere out in social media. They're all over the place. Very large recruiters. They say you're at an XYZ 100% contract. That's what they call it. They actually give it a number name. But then when you look at the comp grid, the only commissions that are actually at 100, let's say in this case, are the most overpriced, hardest to use carriers. And every carrier you'd actually use to help your clients get a good value of coverage pays about 20 to 40% less. So you're really at 60 to 80% contracts instead of a 100% contract. So again, this is stuff that recruiters use to play on your ignorance. Look, not all carriers pay the same commissions. That's certainly how it is with me. But when we recruit people, we say, hey, here's your comp grid. Look at all the carriers and what you're going to get paid. So it's completely transparent. I'm not saying, hey, man, you're at the highest level. No, straight up is the way to roll. And the way I look at it is, if you got to play these games on commission, what other games are going to play with you? You know, usually it ain't the good kind. Now, from the chat here, Mr. Steve, I have to mention this because you brought up something really important. Another problem is show me how the commission grid is structured, and I'll tell you what the carrier values. So for example, I pretty much know which MLM you're at. He started at a commission, was 25%, had to recruit and sell to get higher commission levels. So they started him very low because what they're trying to incentivize in their recruits is to recruit other people to recruit other people to recruit, right? This MLM thing where if you've got a pulse, you go up and talk to random strangers in Walmart and, you know, weirdly compliment them out of nowhere and tell them about this great money-making opportunity, you know, back at my place, whatever. Don't fall for that. Hopefully you won't. But that's the line they use, because in order for them to make more than 25%, they have to recruit people, because if you look at the comp grid, you look at the commission grid, it's structured to benefit those who recruit. So if you're all into recruiting and fine with that, that's fine. But a lot of you here probably just want to sell successfully. You're not necessarily ready yet, maybe in the future, to recruit. And you want to make sure you join an agency that's going to help you get higher commissions based off of not recruits, but production. So you want to make sure you look at the comp grid, see how it's structured. And the vast majority of them on the MLM side are focused on recruitment, production. So you never will get the higher level commissions you could get if you're with a more production-oriented agency. Okay, a couple other things really important. A minor thing, it's not major, but it does happen from time to time. Some carriers don't pay on the policy fee. So if you look at the structure of a carrier or of a product, you have the annual premium plus a policy fee. It's just an added fee. It's like a dock fee at the car lot. And usually agents with most carriers get paid on it. Well, some carriers don't pay. And that policy fee may be 30, 40, 50 bucks a month. And if you're at a 100% contract, like agents starting with us, that's $50, let's say, per policy you're not getting paid on. Well, if you write 100 policies with that particular company, you're not paid on $5,000. Now, you may be thinking, oh, Dave, you're nickel and dime and everything. No, not necessarily, because all these nickels and dimes add up to dollars and hundreds and thousands of them, you know, over time. So you got to mind the gaps. You got to, you know, mind your business a little bit and be worried about little things like this. And so we try not to preferentially write those carriers because, you know, we want to make the most we can while, of course, helping other people. A big problem in this business, and I see this a lot, it really irritates me. There's so many influencers out there. They moralize about whatever it is that they're talking about, how great their shtick is or product is. And they do this all the while knowing that they're shortchanging agents tremendously. And one of the biggest forms of screwing agents is not vesting your business. So here's how I mean. Vesting is the legal term in insurance sales for the ownership of the future flow of income from the residuals and the as-earned commission of a policy. If you're vested from the first day and you own your book of business, even if you leave the agency, you still get paid. You pay all this money for leads, you should own your book of business. But there are substantial carriers that are on YouTube that make content that pretend and make it sound like they're the most honest, transparent people on the face of the planet. That if you look at their contract, you don't own your business for 2 years, 3 years. Sometimes it takes 10 full years before you own your book of business. So why is that important? I'll give you a perfect example. So I can think of one particular company right now. Again, they, you know, big production. We're the best final expense organization on the face of the planet, blah, 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 same old sales shtick. Look at their contract. If you get fired for any reason or terminated for cause or not cause, that means they can just get rid of you because they don't want you around anymore. That residual income that you built all those years now gets rolled up to the upline and to the company. There was a particular person I talked to about 7 years ago who had $30,000 due to him, and this organization attempted to terminate him, except they were 2 days late, and according to the contract at the said insurance company, he was allowed to keep his commissions. But if he was terminated like 3 days prior, he would have lost 30 grand. Lost 30 grand over the next year, guys. Now think about that. That's crazy. You don't want to be in positions to where all of this hard work, especially if you're investing in leads. I could possibly see an argument if the leads are being provided for you not to own your inflow of commissions if you leave. That's different. But if you're buying your leads, especially in this one organization, this is what they do. And you leave, against something that you didn't cause problems to do and you lose that future commission, that's terrible. And this happens every single day because people don't look at the contracts and they don't know what to look for anyway, because this is all insurance lingo. So bottom line, guys, when it comes to commission, this is how you get paid. And this is how you get screwed too on your pay. So what are some final suggestions here before we wrap this up? Number one, don't jump into bed with the first organization that recruits you. Slow down, date them a little bit, figuratively speaking. Make sure it's a good fit. Read the contract. If there's anything that's off about it, ask. Ask people in the business. Talk to people who are producers at the organization. Ask for 3 people to talk to see if the claims being made actually hold up. Talk to people on Facebook. Go to there's a bunch of Facebook groups for life insurance that if you ask questions like this, there's a ton of experienced people that will help you if you will just take the time to just ask instead of just jump right in. And if you do that, man, you avoid so much of this pain and suffering financially that many agents run into, because unfortunately, these organizations are banking on your inherent belief and trust in them. That's why do you think they use the MLM method? To get friends to recruit other friends, because you intuitively trust your friends. Well, sometimes friends are compromised when it comes to money. Sometimes they just don't know either because they're brand spanking new and don't know anything. More reason not to join that kind of organization. So there's my advice. Take it for what it's worth.